Hi guys, welcome to my YouTube channel. Here I am back with another informative video. So the topic of today's video is salary versus dividends, how to pay yourself. We will discuss that what is the best way to yourself from your business. So, in this article, we will discuss how salary works on the corporate level, how salary works at the personal level, how to pay yourself as a salary, advantages of paying a salary or wages, build RRSP contribution room, CPP contribution, avoid unexpected tax bills, approval for the personal loan, paying yourself in dividends, how to how dividends work on the corporate level, how dividends work at the personal level, how to pay yourself in dividends, advantages of paying in dividends, then lower cost alternatives, less administration burden, then reduced risk of the late remittance penalty. Which option pay less tax? Calculating tax for salary versus dividends. Total cost of salary versus dividends in Ontario. Total cost of salary versus dividend in British Columbia. Total cost of salary versus dividends in Alberta. Other tax-free forms of payment, and then conclusion. So, as a business owner, one of the most important decisions you need to make is how to pay yourself. The two most common options includes a dividend versus salary, and each has its own advantages and disadvantages. Understanding these differences can help ensure that your personal finances remain healthy while reducing your tax burden. In this article, we will compare salary versus dividend, how each option works, the benefits and the circumstances which you should choose one option over the other. So, paying yourself as a salary. To compensate yourself for your work, there are few options available. Primarily, you can pay yourself a salary, wages, or the employment income. These terms are often used interchangeably, and we will explore how it works in the detail. How salary works on the corporate level. When a salary is paid, this amount is regarded as a tax deductible expense and will reduce the total taxable income of the corporation. This can be beneficial to the company since it will reduce the overall tax liability. In addition to the tax salary payment, there are other costs associated with payroll, such as Canada Pension Plan (CPP) contribution, which must be matched by the employer. However, when it comes to the employment insurance program (EI program), the business is not required to pay premiums for the employees who also own 40% or more of the company's voting shares. Participation in this program is completely voluntary. So, depending on which provide in Canada the corporation operates in, there might be additional expense related to payroll, such as provincial workers' compensation premium or the employer health tax. These obligations vary for each province depending on the specific threshold to set in that province. Business owners should consider those extra costs when deciding whether to pay a salary. How salary works at the personal level. The total amount of the salary income received is classified as employment income on the personal tax return. It will subject to taxation at the personal income tax rate during the year it was received. You may be eligible for the non-refundable tax credits in addition to basic personal amount. Some of the federal non-refundable tax credits available to the employees include a credit for the CPP contributions made and the Canada employment amount. These tax credits can be used to lower your tax when you pay personal tax. Then, secondly, we will discuss how to pay yourself a salary. If you decide to take a salary for your corporation, you must register for a payroll account first with the Canada Revenue Agency (CRA). Subsequently, the corporation must withhold source deductions from your salary for each payment made, including Canada Pension Plan contribution and income tax. These deductions are then remitted to the receiver general at the end of each remittance period. Moreover, a T4 information return must be prepared and filed for all employees who earned wages during the year. Ensuring full compliance with the CRA's payroll regulation is important to avoid any penalties associated with delinquent reporting or the late payment. So, what are the advantages of paying a salary or a wages? Salary offer many advantages over dividend distribution. So, we'll explore them in this section. Build RRSP contribution room. It is important to consider how you are paying yourself when it comes to building RRSP contribution room. Paying yourself a salary or a wages allow you to create and contribute or to your registered retirement saving plan. Every dollar put into your RRSP is eligible for a tax deduction, and any investment income earned within the account is tax deferred until the withdrawal. So, on the other hand, if you are solely relying on dividends, wouldn't be any opportunity to build RRSP contribution rule. CPP contribution. Earning a salary allows you to make the contribution to the Canada Pension Plan, which in return will enable you to build up a retirement income, although it comes with an immediate cost in the term of deductions from the current paycheck and the related expenses for the employer. The corporation get a tax deduction on the employer's portion of the CPP. It is important to note that when it comes to CPP, the amount you contribute today is taken into account when calculating your benefits upon the retirement. This means that it may be worthwhile for you to consider contributing to the CPP in order to maximize your future retirement income. So, how to avoid unexpected tax bills when you are paying yourself a salary? You can avoid unexpected or the surprise tax bills come April, since taxes are automatically withheld at source on each payment. This means the personal income tax will already have been paid on your salary through source deductions before you even file your return. However, with the dividends, personal income tax isn't deducted from each payment, which often results in a hefty tax bill when filing your personal tax returns. Unfortunately, this can be quite common for those unfamiliar with how dividends payment work. If you don't have a habit of setting aside sufficient funds for the taxes or prefer not to face a large sum of taxes or when filing your tax returns, it might be best to receive a salary instead of dividends. So, approval for the personal loan. When you are looking to qualify for a personal loan such as mortgage or a vehicle financing, and some lenders may prefer to see stable or reliable income sources. This often means earning an employment income or salary as opposed to relying solely on dividends, which may not be looked upon as favorably by the bank or the lenders. Unfortunately, this crucial factor can be overlooked if you focus primarily on minimizing taxes. Therefore, if you are in the process of buying a home the next 2 years, check your lenders on the preferred method of payment, thus allowing you to plan ahead. So, paying yourself in dividends. The second option is to pay yourself dividends. We will explore how it works in detail and how it contrasts with the salary payment. So, how dividends work on the corporate level. If we talk about this point, so dividends are paid from the corporation's net income to its shareholders and are not considered tax deductible expenses for the business. This is because dividends are given out from the tax after given out from after tax retained earnings, meaning that they have already been subject to tax within the corporation itself. Corporate solvency test must be used to provide guidance on whether dividends can be paid and how much dividends can be paid out. In addition, the TOSI rules introduced in 2018 must be considered when dividends are being paid to avoid adverse consequences. In Canada, both eligible and non-eligible dividends can be paid. Eligible dividends come from Canadian controlled private corporations (CCPs), uh, which are taxed according to the general and corporate tax rate. In contrast, non-eligible dividends come from CCPs that are subject to the small business corporate tax rate. So, how dividends work at the personal level: an individual may be required to pay tax installment on a quarterly basis if their tax payable exceeds $3,000 in the current year, or either the primarily receive dividend payments, as dividend income is considered investment income and not subject to the withholding tax. When calculating taxable income to be reported on the individual's tax return, dividend payments are grossed up by the additional 15% or 38% depending on whether it's an eligible or non-eligible dividend. For example, where an individual receives a dividend payment of $10,000, they will need to declare 11,500 or 13,800 in the taxable income on their tax return depending on the type of the dividend they receive. The value of this gross up means that the amount of taxable dividends can significantly impact an individual's eligibility. The certain income tested benefits and the tax credits such as GST, HST credit, old age security, and the Canada child tax benefits. In addition to the basic personal amount, the individuals are eligible for a non-refundable dividend tax credit, which is designed to reflect corporate tax already paid on this income prior to it being distributed. This credit can help reduce the overall amount of tax payable by the individuals receiving dividend from the corporation. How to pay yourself in dividends: paying dividends to shareholders of a company is relatively straightforward. The business will declare the amount of dividends to be distributed, then transfer funds from the corporate account into each shareholder's personal account. So you can take money out of the corporate account as needed and then record it as for the total yearly distribution. The company must then file a T5 information return for those shareholders who received dividends. Special attention should be given to the allocation of the income among different shareholders that own the same class of shares, as it can be difficult to determine how much each business owner should receive. For example, if your corporation wants to distribute $50,000 in dividend payments to the owner of the common shares, it must do so based on each holder's percentage of the ownership. So what are the advantages of paying dividends? There are many benefits of the paying dividends. Has overpaying a salary. Will dive into the advantages in the greater detail. First of all, it lowers the cost. Alternative: when it comes to reducing the cost associated with paying salaries and the wages, so many business owners are turning to the dividends as an alternative. Paying dividends instead of a salary can help to reduce corporate cost because you are not required to pay the employer's portion of the Canada pension plan. The maximum employer CPP contribution for each employee is $4,034.10, which is calculated at 5.95% of up to 71,300 dollars pensionable earning in the excess of the $3,500 annual basic exemption plus second additional CPP contributions of $396, which is calculated at 4% of the up to 81,200 pensionable earnings in the excess of the $71,300 annual maximum pensionable earnings. Also, employers may be subject to additional employer health tax in some provinces such as Ontario, British Columbia, and the Manitoba. So, this particular form of tax is determined by how much total salary, gross or gross payroll the employer pays out to their employees in given calendar year. Fortunately, these levies do not apply to the dividend income, meaning that businesses are able to avoid and minimize their employers' health that expenses by choosing to pay the owners in dividend instead of salaries. So, less administrative burden. If you are the sole owner of a corporation, it is relatively straightforward to distribute dividends to yourself for your own use. This process is much simpler than paying out wages or salaries, which involves payroll registration with the Canada Revenue Agency, calculating source reduction on each payment, and remitting payroll deductions based on the frequency of remitting period. To distribute dividends, all that need to be done is that declare an amount and transfer it from your company bank account to your personal bank account. Although the T5 information return still needs to be filed once a year to report the total dividends paid to each shareholder, there is less administrative burden by paying out the dividend. So, a reduced risk of late remittance penalty. By choosing to pay dividend instead of salary, there is reduced risk of penalty for late remittance. This is because you are not required to remit source deductions on dividends, but for the salary, you must make payroll remittance consistently throughout the year based on the required remitting period. So later or missed payments can incur a penalty of up to 10% on the remittance amount. If you are concerned about being able to make consistent payroll remittance, dividends could be a right option. So, which option pays less tax? When assessing whether salary or dividend pays less tax, the answer is not always clear cut. That's because of integration, which is a concept within taxation legislation that aims to ensure that when the overall income taxes are paid, which include both personal and corporate taxes, it would be relatively the same regardless of the payment form chosen. So, salaries generally reduce corporate taxes, resulting in higher personal tax. Dividends payment, on the other hand, dividends do not reduce corporate tax but create lower personal taxes than salary payments of the same amount. Integration works to the bridge of this discrepancy by taking into consideration a variety of the factors such as the level of corporation tax rates and the personal income tax rates, and individual taxpayers receive a personal credit for corporate tax paid on the dividend payments to ensure that the overall income tax burden remains relatively consistent when compared to the salary payment. So, as you can see in these calculations below, the integration is not perfect and there are tax leakages depending on the amount paid and the province you are located. So, calculating taxes for the salary versus dividends. To better understand how taxes are calculated for the salary versus dividend, let's look at a scenario for payment of the $100,000 and $200,000 in Ontario, British Columbia, and the Alberta. We will calculate the overall amount of taxes, both corporate and personal, that would be paid if salaries were used, and compare with this amount of the taxes that would be paid if dividends are used. A similar result applies to other provinces and the territories. So, total cost of salary versus dividend in the Ontario was, so, salary of $100,000 in the Ontario. So, corporate tax savings salary paid was $100,000. Employer's portion of CPP is the following. So, total corporate tax saving was about 12 lakh and $740,000. So, For the personal tax cost, this was the 12 21,000 2 lakh 1 10,000 and $31. So total cost of salary was this, and the total cost of the dividends was this. So that was all about the discussion. Hope this will be beneficial for you. So do subscribe my channel for more videos. Thank you.